The story of the dominant coconut water brand in the U.S. today began at a bar in the Lower East Side in February 2003, where best friends Michael Curbin and Ira Loran struck up a conversation with two women from Brazil who told them the refreshment was what they missed most about their home. That night was the beginning of a whirlwind love story for Loran, a Columbia graduate who sold everything he had and moved to Brazil to marry one of them. When Curbin flew down to visit later that year, he was surprised at how ubiquitous coconut water was. Servers at restaurants would ask if they wanted still, sparkling or cocoa. Curbin, a software entrepreneur, was ready for a change and convinced there would be a market for the product in the U.S. The two friends founded Vita Coco in 2004 and faced stiff competition in its first decade as others had the same idea, but pulled in investments from celebrities like Madonna, Matthew McConaughey and Demi Moore. The New York-based company now has a supply chain that sources coconut water from 14 factories in 6 countries. "You can't just turn on the faucet," says Curbin, 48, now Vita Coco's executive chairman after handing the CEO reins to Boston beer veteran Martin Roper last year. "We've got thousands and thousands of farmers climbing trees every day to get the coconuts down." Vita Coco went public in 2021 and has taken off in the last year, tripling since last November. Sales in the last 12 months are up 14% to $479 million, and net income is up fivefold to $37 million with freight costs easing compared to last year. Curbin envisions coconut water one day becoming as big as orange juice. Those strong growth figures helped Vita Coco rank 17th on Forbes's annual list of America's most successful small-cap companies, and its stock appreciation has been rare among small caps in the last year. The Russell 2000 index is down 2.8% this year and is still 30% lower than its 2021 peak, with this year's mega-cap recovery leaving small companies behind. Small caps generally underperform entering a recession or economic slowdown, and this year's high interest rates and slowing consumer spending are holding the group back. But investors like Laird Beeger, co-portfolio manager of the $1.3 billion Barron Discovery Fund, think they will snap back in the long term. He points out that the Russell 2000 Growth Index is trading at a 5-point discount to its historical P/E average relative to the S&P 500 index. From a relative valuation perspective, it feels like small caps are about as discounted as they can possibly get, says Beeger. "I think we're going to look back at late 2023 and early 2024 and say to ourselves this looks a lot like what we saw in 2003 after 3 long years. Coming out of a slowdown is when small-cap growth really shines." In 2003, small-cap stocks as measured by the Russell 2000 climbed 45% after suffering a loss of 22% in 2002. To find the top 100 stocks bucking the trend, Forbes looked at 974 U.